Well, in many ways, we are just trying to unpack the market action over the last couple of trading sessions. It was catalyzed by the jobs report on Friday, which saw lower than expected job growth, and then it was punctuated by the Bank of Japan hiking rates and signaling that it would try to shrink down its balance sheet. This unwound the so-called carry trade, where people borrow in Japanese yen and invest elsewhere. And we saw big swings in the market. We saw big pullbacks in the S&P 500. The Dow plunged 1,000 points, the first time that's ever happened. That's likely to more happen as, the Dow starts to be worth more on a points basis. But still, it was pretty significant. Now, we rallied from there, but it led to a lot of calls, including some for the Fed to step in, perhaps on an emergency basis. One of those voices was Jeremy Siegel, Emeritus Professor of Finance at the Wharton School of the University of Pennsylvania and Senior Economist at WisdomTree. Professor Siegel, thank you so much for joining me. I mean, on Monday, we were on holiday in Canada, and maybe thankfully so, because it really seemed like things were falling apart. You said we need 75 basis point cut now and then another 75 in September. Do you still stick with that call, given it seems like cooler heads are prevailing?
Right. Well, I'll tell you, it isn't that I saw things falling apart. I just think the Fed funds rate is far too high, and I do not want the Federal Reserve to repeat the mistake that it made 3 years ago, the bad mistake of being way, way too late in raising rates. The point that I'm making, and I didn't mean to say that we're falling into a recession or that things are in crisis now, but it is very puzzling to me that we increase unemployment 4.3%. That is now blown past the Federal Reserve's long-term 4.2% rate. We are within 0.5% of the inflation target. And yet we have not moved at all on the Fed funds rate. In other words, we've moved 90% on one of the two variables the Fed looks at. We've moved over 100% on the other one. Why have we not moved on that? One of the things I pointed out, the last Fed quarterly meeting where they put out the dot plot and the projections called the SEP Summary of Economic Projections, the Fed said that it believed that the long-run Fed funds rate was 2.8%. And that is when unemployment's 4.2 and inflation's 2.0. Well, as I mentioned, unemployment is now 4.3 and inflation is 2.5, and yet we're nearly double that rate. We haven't moved at all from the 5.4% Fed funds rate that we have established over a year ago. So I just think we should be at least halfway down. I think the Fed funds rate really should be in the 4% level right now. And I didn't mean to imply that, oh my God, things are falling apart. I just I'll try to understand, what are they messaging? What are they trying to tell us when they tell us the long run is 2.8, we're almost there, and yet they don't move?
Are the 70s maybe sitting with them in the sense that they'd rather be a little bit behind the curve and risk inflation coming back up? Because, we're going to get a read of inflation next week. Just headline year over year, you can torture the data in a number of ways. The headline year over year number is still sitting at around 3%. And the improvement we're looking for is to 2.9%.
Well, first of all, let me answer to the 70s, because I actually did studies of the 70s. Very different time. And that was the worst, the second worst monetary mistake in Fed history, the worst being how they reacted during the Depression, but the second worst was the 70s. Arthur Burns, trying to offset the restriction from the OPEC oil cartel, pumped money in at 10% per year for nearly a decade. Our inflation was 8 to 10% for 9 years. We are nowhere near that situation today. In fact, M2 money supply, which I follow, quite closely, is below where it was 2 years ago. we're not actually putting out enough liquidity for even a moderately strong economy. So we are not in the 1970s. Take a look what's happening to commodity prices. Even with the potential crisis in the Mideast, commodity indices are down 20% from their highs. So I do not see the 70s. And I don't doubt what you're saying is in the minds of many of these FOMC members, but I'm trying to tell them that should not be a concern, and you should be moving down, or you should be messaging to us, well, then what is your long-term targets? Because it certainly doesn't seem like the data that they put out last June is what they're looking at today.
I wonder if this recent episode, though, in the markets exposed or maybe foreshadowed a negative reaction by investors if we get that kind of easing in the U.S. at the same time that that Japan is tightening, and I use that word kind of in air quotes. They've also, acknowledged what happened, and the Bank of Japan officials have said, we won't do that in market turbulence again. Notwithstanding that, did it expose a weakness there, that if you get that sudden weakness in U.S. monetary policy, that you cause this unwind that actually puts pressure on equities?
Yeah, and listen, I wanted to mix things up because I think Jay Powell is far too cautious, far too deliberate. He certainly was 3 years ago, as we all know. First, he has to tee it up, a cut, and then he talks about a quarter of cut. I was disturbed. He even said 0.5% was not on the table. Well, now actually the markets think it's going to be 0.5%. I just think the deliberateness of his thinking is just too slow. Short-term interest rates, by their nature, should be more volatile than long-term interest rates. And instead, he's made the process that making long-term interest rates more volatile than short-term interest rates. So clearly, given Jay Powell's modus operandi, I certainly don't expect him to do an emergency cut unless things are bad. But I wanted him to realize, and the Fed to realize, that they are far away from the type of policy that they laid out in June being near targets at and now beyond targets with that Friday employment report, and not moving 1 inch so far on the Fed funds.
Oh, I'm glad you framed it that way, because you're talking about what they should do rather than what they're likely to do. So let's stay in the camp of what they're likely to do and talk about the consequences of that, because we've already seen unemployment tick up, because inflation, to your point, has been coming down. So they're not going to do what you think they should do, Professor. As a consequence, what's going to happen in the economy?
Well, let's put it this way. I think that 50 basis points should happen, definitely, and that they should message that they now feel comfortable in moving it down as rapidly as they moved up. Remember, they moved, 4 times 75 basis points on the way up. And I'm not saying the economy is slipping. I'm just saying either tell us that those targets are not what you stated in June, that you actually think Fed funds should not end up at 2.8%. It should end up at 4 or 4.5%, and that's why you're going it deliberately. But clearly, again, it's a question of messaging. Where's your anchors? Tell us what your anchors are, because clearly you are not following the anchors of your policy statement that you put out on a quarterly basis.
How much of this gets thrown into disarray if inflation next week surprises to the upside?
Well, I believe actually that inflation has come down more than the official figures. I've been a big critic of the shelter component of the way the U.S. computes the rental and owner-occupied rent way too slow on the way up back in 2021 and 22, and now it's come down. way too slow on the way down. I actually, my own computations fitting in current shelter data actually show that the Fed has achieved 2% year-over-year growth. That rental prices have actually stagnated over the last 2 years, as followed by apartment list, and they're only up 2 or 3%, followed by Zillow. These are on-the-ground current indicators. According to the BLS and the Fed, the shelter, and remember, shelter is 41% of the core CPI. So it's a very, very important component. According to them, it's up 4.5% to 5%. So when I think they're overstating inflation, overstating forward-looking inflation. I think they've reached their goals, and I would like to see them, if that be the case, that they then move down towards their stated 2.8% normal Fed funds rate.
I want to address maybe the larger issue that the Fed is a little bit behind the curve. And we hear this complaint. You're certainly not the only one who has thought that. But I'll put this another way. Generally, the forecasting by central bankers has not been great. Do we want them to be making policy based on what they're forecasting or based on what is actually happening? And can you not give them some credit? We were expecting a recession, right, at this point. By all accounts,
right.
The Fed, and I know fiscal policy is a big part of it, but they're nailing it, right? They haven't caused this big accident.
They have. Even after terrible mistakes in 2021, that really caused the inflation to get really out of the control. I have to give them credit so far, but I'm using actual data. And Jay Powell has recognized that monetary policy works with a lag. So if it works with a lag, why are they at the same level of restrictiveness as they were a year and a half ago, and inflation was much higher and unemployment was much lower? So Fed must do some forecasting because of the lagged effect on monetary policy. But even if they don't take into account that forecast part, just looking at what the data has done right now, they should be moving down. I mean, Austin Goolsbee was also on Monday, and basically, he actually stated they're actually increasing their tightening by not doing anything, because as inflation falls, we know that the real interest rates, which is really the cutting edge of policy, is actually rising. So that makes no sense to me. I mean, why when you're getting quite close to your goals right now, in fact, overshot one of your goals, are you, in fact, tightening effective monetary policy? I want them to confront these questions. I think they will at that September meeting. It's not that I'm saying that things are falling apart. I'm saying what is your long run? What are you going for? Are you totally reactive? Are you just going to wait till things fall apart and then say we go down 50 basis points? Clearly, that's far too late.
And maybe we'll get it.
And that's why I put a pretty extreme statement there. But the very well-known monetary policy rules, such as John Taylor called the Taylor Rule, there are many others. They all point towards 4% or lower today, which is 150 basis points under the current Fed funds rate.